December 13th in the afternoon. We're going to talk about the S&P and the volatility that we've been seeing today. So last time we had seen that the market was on a confluence of two support lines that were generated by a proprietary tool that we use that indicated there might be a bounce. And the market started slowly and then today exploded. The report generated a 180-point move up and later in the day a 150-point move down. By the way, in the 1987 crash, the S&P futures fell 180 points. We saw double that in one day today. Now, of course, percentage-wise, it was a tiny amount, but in terms of the futures contract, you would have made as much money today as you could have in the crash of 1987, just to keep it in perspective. Now, what I want to talk about today is the next weeks and what's likely to be the context in which this market is moving. There's a tremendous amount of uncertainty that's growing now. What's happening is it looks like the market may be holding more of a bullish tone. And at the same time, you're hearing about people talking about crashes. I get phone calls this week about December 11th is the beginning of a crash. The reality of it is the market's probably going to be boring. Despite these intraday crazies. Most of the patterns that we are inspecting turn out to be more trading range type moves. We could stay within a range that's slightly higher than where we are, up into the 4,400 area. And we could go down perhaps even into the 3,400 area between now and April. However, this is not the extreme type of market that has been talked about. If it does break up and does become more bullish, it's not likely to be a new bull phase. And if it does break down, although many people are thinking the 2008 market is repeating, it's not likely to have a severity of that decline, at least now. After April of next year, there could be, all bets could be off and we could have more severity, okay? But until then, I want you to keep it in context because the cycles are kind of mixed. There are forces that are holding the market from going down, and there are other forces that are actually larger that indicate we're in a very, very long-term bear market. And along the way, in that bear market, you could have rallies. And right now, we're in one of those modes. Okay, but what about the short term? What about the next month or two? All right, we've been saying in December we're expecting a decline. It started, it went sideways. Today it took out the high of that, of the November 14 and November 30th highs. Even this does not mean anything. It's still likely to go down further in December. Now, if you look at the charts that we have, a few charts, I want to let you know that the research that we've been doing over 35 years has uncovered what some people have called the unmanifest geometry underneath the surface level of visible structure of the market. I showed you a couple of lines last week which indicated something that wasn't usually seen in terms of these parallel lines and these diagonal curves that were supporting and resisting the prices in the market. In the next few charts, you're going to see more of that. And I want you to recognize that this stuff is what's really real, you know? You can say all the things you want about all the large firms and all the big hedge funds and the big banks doing whatever they're doing. But the truth of the matter is that the markets are controlled by nature, by natural law, by the collective consciousness of the world and of specific markets. And the reason we know that is because these lines were there before any action that any of these people took. And it doesn't matter what goes on, they're still going to continue to guide the trends. Oh, also, by the way, we do teach this stuff, you know. We just finished a course recently. It was very, very good, very enjoyable, and very successful. And we will be doing another one starting on Sunday, December 18th, for those people who are interested in learning something about the forecasting techniques that we've been using, and you should be able to learn from it enough to actually do it yourself, or at least do a good deal of what we're doing by yourself. So I recommend, if you're interested, take a look at the link after this video and you'll see more about it. Now, going back to these charts, the first chart you're looking at is a bunch of downward sloping parallel, not quite lines, they're actually curves, and they've been there the whole time. I could have put them up there 10 years ago. And the market has conformed considerably with a high level of correlation to those lines. It has bounced up into them numerous times and fallen. In the last year, there were 13 occurrences where it rallied up into these lines, and those little squares on the chart indicate where the market fell down from those points. Now, this is not a trading technique by itself, and you need to see that there were other points along the way where it did break through the lines. But the fact that it stopped so many times and reversed so many times, and in many cases had large declines coming off of these downward sloping lines, they're forces. They're lines of force in the market, and they're generating the direction of the future. And when the market runs into them, sometimes it'll break through, but quite often it won't. When it breaks through, it means there are other forces that are also going on that are stronger. I'm not complicating the story by showing you everything. But these are very common, and they're always in the market. And in the present market, this is why I'm bringing it up, we just ran up into that line again, into that downward sloping line. And that was very, very close to the high today. The price of our line was at 41.82. The high on the futures was 41.80. Which, by the way, 41.80 was a target point that I had mentioned weeks ago as a potential high point for this swing. The other thing I want you to see is that there's a 2-month swing up and a 2-month swing down. It's been going on, again, a 4-month cycle. It's well known, but we're just delineating it so you can see it clearly. And we're right up against that high area that the 4-month cycle would indicate. It could come out a day or two from now. It could even come out as late as the 21st of December. But the market should go down afterward. And the next low of this particular cycle is February 7th. Okay? Now, that does not mean the market's going to collapse down until February 7th, or it's going to do exactly what it did 4 months ago and go down for 2 months consistently. But it does mean there's probably a low on February 7th, and that the market's going to have some downward push immediately that should take it lower. Last time we talked about a January low, and then potentially there's a little bounce in January, and then another decline into February. So that's one thing you want to consider. All right. The second thing you want to look at is the upward sloping lines in the next video, in the next chart. Those are the same forces, except sometimes they trend up. And when they trend up, the market has a tendency to respect them as well. And this last rally that started in October has been within that channel of these parallel upward sloping diagonal lines, and they have been very effective. And our recent low a couple of days ago came in right on the line again, providing support. So when it comes down to them, they become support lines. When it goes up into the lines, they are resistance lines, and the down sloping ones are more likely to be useful in a downtrend, and the upward sloping lines are more useful in a uptrend. Okay. All right. So that's the next step. The third thing I wanted to show you is what we're likely to see going forward in terms of the future. Now, one of the things is, there's quite a bit of a correlation between 18 years ago and now. It's one of the better patterns. And the reason I bring it up is because it shows you where we're at is very close to a little high point. If you look at this pattern recognition format, the correlation is quite high between December 24th of 2004 and now, December 12th of 2022. And you see that we're near a decline phase that would go down into early January, and then there's an up phase, and then a further down phase that comes out and that goes down later in the year. Okay. I also wanted to show you and compare it to another cycle This one is 14.25 years, and it has been time-wise repeating very, very accurately, and this is what all the panic has been about. If you look at the 2008 market, the swings in that market have been repeating, but the price action is not repeating, okay? In other words, the severity of the decline at this point was far lower than the present market, and this rally that we had in our present market the last 2 months is much stronger than what happened back then. However, we do have a decline phase coming for a couple of months, and that was where the most extreme crashy type of action happened in 2008. That time frame also lines up very closely with a low around February 7th as the next low in that chart. But I'm recommending don't get attached to the extreme thinking that that's going to be a crash, because it's probably not. But it is in there. It is a cycle of 743.8 weeks, 14.25 years. It does align with other cycles we've been looking at, including the 37-year cycle. So it isn't non-existent, and it does go down until June. And some of the other patterns do have a low in June or July also. And so we can expect that there's a possibility that after this high that we're looking for in April, that there could be a decent-sized break at that time. But until then, we don't expect it. We do see a decline in December, but not a dramatic one. Now, also on this chart, you'll see what we have these two little pink lines. One is above and one is below. The first pink line we call a target line, and that was an expected line that the market would likely hit, and it did it today. We didn't know it would do it today, but it did it today. And there's another one we call a target line that's on the underside, and it's down around 37.50. And we've been saying this for the longest time. This particular technique generates price levels. It does not necessarily say when. But using the cycles combined with the time, with the price projection technique, you can very often catch decent moves very, very reliably. And so at some point it will come down to that 37.50 area, and probably on the next swing, because it's not that far away. All right, a disclaimer also, because I'm getting more and more people following this. I want you to recognize I am not always right, although you may find that I'm right quite often. I have been the last 12 months on these videos, which you can verify. But you have to take responsibility for what you do. What I recommend is to always use some kind of a stop loss order, and that always, if you don't do that, at least to hedge the positions. Because today the market was so strong on that report that if you had hedged with a small amount of money, you could have easily offset any risk or any losses that occurred if you were short. And I think it's a good recommendation. People buy insurance policies whenever they go, medical insurance and such. You spend money on it. Most of the time you're not sick, but if you wind up in the hospital, it can cost you a fortune, and the medical insurance will allow you to get through that without additional stress. So hedging is a useful tool, and there are ways to do that which are easily accessible on the web. And also putting stop loss orders in is also very, very, very important, considering the volatility, which is exceedingly extreme. I mean, more extreme than you've ever seen in terms of price movements. To get 300 S&P point movement in one day in both directions is unheard of. And it's also potentially extremely profitable. But you have to use stops. All right? That's the disclaimer. I hope you have a successful week, and we'll talk to you soon. Thumbs up, please.